To say that the first 6 months of this year was a very volatile time in financial markets, locally and globally, would certainly be the understatement of the century. We started the year in global equity markets on the front foot, but when the coronavirus broke out, financial markets came under severe pressure. Local equities sold off aggressively, with our own equity market selling off about 36% from the highs that it recorded late in February. Globally, equity prices lost about 34% in dollar terms of their values. However, markets recovered significantly since the lows that were recorded on the 23rd of March this year. Global equity prices went up by about 42% from those lows. And you would recall at the time when the market sold off, we just thought that that was overdone, and that when we position portfolios, that we position them for a through the cycle scenario. So the overdone action by financial markets provided us with an opportunity to increase risk in our client portfolios. Not only locally, where we added about 5% to multi-asset portfolios to equities, but also internationally. In the high quality fund, we have used the liquidity that built up in the fund over the period to reduce that liquidity significantly when we bought those equities at much lower prices. Well, unlike other bear markets that we've studied over the last 100 years, we've seen a material recovery when global equity prices recovered about 40% off the lows, and the South African market is about 25% up from those lows. Which simply means that the equities that we bought in that weakness, those purchases look very good, and clients had the benefit of the increased risk that we've built into the portfolios, both locally as well as internationally. However, if you compare the current recovery in equity prices with previous bear markets, I think it is fair to say that this recovery is certainly different to the past. In the first place, it is much faster. And in the second place, what you'd normally find in recoveries is that the value equities lead the recovery, with the household names that had the performance behind them at the time when you went into the bear market, with those household or highly valued shares lagging in this recovery. This time it was different, where those momentum stocks continued with very strong momentum, and we can now clearly say that those stocks are quite expensive. So what do we do now? Given the very strong recovery, you can understand that the prospective returns for global equities in particular has been reduced significantly. So as a result of that, we would suggest that we take some money off the table, or we take some profits on those shares that performed very well. It might sound very opportunistic, but just to put that in perspective, you would normally expect equities to do about 5% above inflation per annum if you look at the longer term experience. That gives you, with inflation at about 1 or 2%, it gives you a 7% per annum prospective return for equities. Global equities are up 42%. So that means in the last 3 months, we had 7 years of performance arguably off a low base. Given this very strong recovery, we sold equities at these arguably expensive prices to lock in some of the profits that we've built in by the increased risk. I think it is also important that we look beyond local and global equities. The first thing is to say, if you look at other asset classes, is that if you look at global bond yields, in the US 10-year bond yields trade at about 0.7%, which means if you hold those bonds for 10 years, your return will be 0.7% per annum over the next 10 years. And I think most of you as clients would recognize that not many of you would be happy with that kind of return. So the only reason why we would hold global bonds in the portfolio is that in times of crisis, those assets normally responded as a shock absorber. But in terms of prospective returns, those returns are very muted. If you look at cash as an investment opportunity, of course your cash returns globally is almost zero. And in South Africa, as a result of the cutting interest rates that we've seen, in South Africa you can only get about 4% pre-tax returns if you invest your money for the next 12 months in in liquid fashion. So I think it is true to say that if you look at across the spectrum, the prospective returns that we're talking about look quite muted. And therefore, I think we need to be very nimble to use shorter term opportunities to the benefit of our clients. I think to conclude, the elephant in the room that we seldom speak about is gold as an investment. Now, what you normally find in times of uncertainty, gold performs quite well. This time around, it was not different. If you look at the performance of the gold price since the beginning of the year in dollar terms, it's up 17%. However, if you look at gold shares that get the geared performance from the higher gold price, those gold shares are up almost 90% since the beginning of the year. We did not invest in gold shares because we think the longer term prospects for the gold companies where the gold price is trading now is not that great. However, you can make a point that you should have some gold in portfolios when interest rates are low and when uncertainty is high. Given the performance that we've seen in the gold price, we think most of that is probably behind us. So whilst we regret not having gold or gold shares in the portfolio over the last 6 months, we think that there are other shares, particularly value shares, both locally and globally, that are likely to perform better than gold, and therefore for the time being we will stay put, except if the gold price comes off and presents us with a better opportunity to invest. So in short, uncertainty I think will prevail. We are not exactly sure how the COVID virus will play itself out internationally and in South Africa. We've seen a significant bounce in risky assets. We've taken profits. We have now put a portfolio together that has got less risk. Should assets come off for whatever reason, we would use that opportunity to increase the risk in the portfolio again, like we've done at the time when assets sold off in the first quarter. So I think clients just need to bear with us. We don't write the history. All we can do is we can position the portfolios to get the benefit of this very extreme price movements in our portfolios.